Hi. Are you anxious with what happened in the markets last week? Are you curious to find out what's going to happen to your open trades, your investments, and the outlook on the market in the coming few trading sessions? If yes, please continue to watch this video. Last week, I advocated as per the Jensen's measure. Now, this is a tool which is used by frontline heavyweight hedge fund managers to basically compute the risk and reward per trade before they deploy their money in the markets. The Jensen's measure, I warned you, had turned hostile against the bulls and the markets were no more conducive to going long. And guess what? Things worked out exactly as I expected and as I advocated, and the markets did turn into negative on a week-on-week basis. Now, we're going to take this video forward where we left off last week, and I'm going to attempt to gauge where the markets are headed next week. So do join me in this couple of few minutes of market talk as we basically try to decipher the signals of the market so that I can help you navigate through the traffic of the market better in the coming weeks. Friends, I'm Vijay Bhambwani, a professional trader with 35 years of trading experience logged in behind me, 28 of which were as the founder, promoter, CEO of an incorporated limited company which trades for a living. I don't have anything to offer you to sell, no webinars, no financial products or services, so I have no vested interest in asking anything from you. Let's dive right into this video and see what happened. Coming up on your screen is the market roundup, which basically shows you that the Bank Nifty underperformed the Nifty 50 exactly as I have been telling you in my previous videos that I prefer the Nifty relatively speaking as compared to the Bank Nifty because of the strengths involved and the broad-based composition of 50 stocks compared to the Bank Nifty being made up of 12 stocks. Now, the Bank Nifty, relatively speaking, hurt the bulls grievously. Bullion also managed to rise because there was some amount of concerns over the financial asset class which was witnessing profit taking. And the US dollar fell against the rupee. Now, believe me, this is a very critical aspect and it is often ignored by rookies. The US dollar fell against the rupee, which cushioned the declines in the emerging markets, including India. Had the dollar risen against the rupee, we would have seen deeper declines and a far more vicious sell-off. What would have otherwise been a steeper fall was also avoided by lower natural gas prices, although oil prices rose marginally, which also pressurized our indices. The bond yields fell by 1 basis points and bond prices firmed up a bit. I'll talk about bonds in the segment where I dedicatedly discuss bond yields as a separate asset class. Coming up on your screen is the market-wide position limits, the MWPL chart, which rose 74 basis points only. Now, this rise is basically slowing down, which is expected as we head towards expiry. Now, what we are basically seeing is that bulls continue to ramp up their positions, even though slowly, in spite of being 3 sessions away from expiry. Now, this can drive beta or volatility sharply higher because as we head towards expiry and if the markets fall, the same guys who are buying now in bottom fishing and trying to average their trades will have to come out there and start to unwind their long position. Now, that might create a problem at a later date. The chart of basis, the difference between the future and the spot segment on your screen, shows that basis rose on a week-on-week basis because the Friday prior to last week, which is basically telling you that the selling had started then and the basis had turned negative. So in spite of the fact that basis has risen at the beginning of the week, but it tapered off almost towards zero. Now this is something which is a routine. Ahead of expiry, the basis is supposed to converge to zero, and the futures price and the spot price do happen to converge and meet at zero. So falling basis towards zero is a natural phenomenon. Now take a look at the volumes chart. The screen shows you the cumulative volumes of all future series, January, February and March, in both the indices and the stock futures. Now the volumes, and this is a worry with me, have risen in spite of the fact that the markets have fallen, which means that the selling pressure remained intense till the end of the week, and markets falling on high volumes can never be good, right? Let's now come to the 10-year benchmark bond yields. I repeat my words to you that I have been saying in all these weeks. Do not let rookies or the so-called experts mislead you into believing that bond markets and the currency markets do not matter. Even if you are a pure equities only trader, you will ignore the bonds, the currencies and the energy market, especially in the commodities space, at your own risk. All the markets are married to each other. All four asset classes are married to each other. And it is only an unwise trader who will shut out three asset classes and look only at one, because there's a pull and push of all asset classes on each other. So the bond yields rose by 1 basis point, which indicates a mild increase in the bond prices. Now that also basically cushioned the decline in bank Nifty and the banking stocks, because the mark-to-market valuation of the bank's bond portfolios basically showed a very, very mild negligible uptick. Now the RBI action on the variable rate repo auction is something that I talked about a fortnight ago, and I reiterated that stand even last week. The impact was felt along expected lines. The RBI mopping up liquidity from the banking system, sucking out extra money from the banking system, means that there will be lesser easy and low cost money available. Now remember, for a bull market to sustain itself, as some people say on Wall Street, easy availability of money at low interest rates is mother's milk to a bull market, right? So you take away liquidity and you start endangering the sentimental feel-good factor within the bull camp. Now, if you were connected with me on social media, you would have read an early morning post on Friday from me, wherein I had provided a hyperlink to a media article where the RBI said, where the RBI said they are likely to mop up even more liquidity from the banking space. So in the coming days, more and more money is going to go out of the banking system, and that might be a worry on the sentimental front in the markets in the coming few weeks. Now, this is something that you definitely should not ignore and jump only into equities. I would urge you to connect with me on social media. My contact coordinates are coming up at the fag end of this video, wherein I update these aspects of the markets with numbers and hard data. As a matter of fact, we've also started putting up end of the day graphic giving out all the details of how the markets behaved during the day, including the US dollar peg on the NSE derivative segment, the turnovers, the futures, the basis, giving you even the market-wide position limits, bond yields, and the projected supports and resistances for the next day on the Nifty and the Bank Nifty futures. So do touch base with me on social media and even on YouTube. Do keep checking this end of the day file. Now I come to the US dollar index, the Dixie. Now this is a benchmark index of the US dollar versus the global basket of currencies. This is again a very, very critical aspect for any market watcher to basically watch out for. Because India is a net importer nation, and whatever we import becomes cheaper if the rupee strengthens against the dollar, and it also helps curb inflation. So the fact that the bond market showed more pain last week, we basically got minor relief from a weak US dollar, and we are likely to see fuel prices being a very important trend determinator in the market. If oil prices were to rise, and I call oil a multiplier commodity because everything from fish, meats, eggs, vegetables, grains, medicines, clothes, footwear, electronics, everything becomes expensive if the dollar is firm. And that basically triggers higher inflation. Inflation is nothing but misery index by another name. So don't forget to check on the dollar every day. I put this up on my social media pages like I mentioned. And as you can see on your screen, the Dixie chart shows that the dollar rose only on 2 out of 5 trading sessions, even though there was one holiday on Martin Luther King, but electronic trading did take place. It was very thin though. Note how the price is now below its 25-day exponential moving average, and the 90.85 level will be a big hurdle on the upside. Note how the trend lines, whenever they've connected, have indicated turbulence or reversals. Now, this is something that I discussed about in my video, a tutorial video on trend lines on the 20th of January. Admittedly, the upper trend line was drawn only after November 2020, but it is still validating these signals in retrospect, which is what Connie Brown talks in her fantastic book on the CMT course material in chapter 4. I would urge you to read that book very, very carefully, because even trend lines that you are drawing later, if it's catching retrospective action, it gains all the more credibility. So although there might be some people who might accuse me, this is a trend line which catches action in hindsight, fine. You guys haven't really read what Connie has to say, so we'll just leave it at that. And take a look at the weekly chart now of the US dollar index. Note how the last red candle has pierced the body more than halfway through of the previous bullish green candle. Now, this is something similar to a person being stabbed. Will the person recover? Will the price recover? Yes, but only if the high of the red candle, which is at 90.94, remember I mentioned 90.95 earlier. Now, only if this high of 90.94 is overcome and the market trades sustainably above this level. Now, last week I advocated a potential range between 91.95 on the upside and 89.65 on the downside, which held perfectly. The coming week may witness an estimated, I emphasize on the word estimated here, a range between 91.30 on the upside and 89 on the downside. You must watch the Dixie, the bonds and oil and gas prices carefully in the coming weeks, even if you are just an equities trader. We now come to the Bank Nifty, the second most liquid counter on the NSE, where impact costs, bid and offer spreads are concerned. So I've been talking about the underperformance of by the Bank Nifty in relative comparison with the Nifty 50. And in this segment, I'm also going to share my reasons why I've been saying that the Bank Nifty will underperform the Nifty 50. And this hypothesis that I had, it's not just a hypothesis, it's proper working out there, has been validated by the price action in the markets last week. Because this index lost 3.35% on a week-on-week basis compared to 0.43% of the Nifty on a week-on-week basis. This index notched up very mild and small gains on 2 out of 5 trading sessions, but the losing candles, the large red ones, are far more prominent and vicious, which means the selling pressure remained extremely omnipresent and high. Note how the index was making higher highs, but the RSI in the second window below was making lower tops. Now, I've marked these two higher highs on the price and lower highs on the RSI with bold red trend lines. This is called negative divergence. This basically shows that the bulls are losing steam, and this invariably occurs as a precedence before a fall. Now, this was one of the many reasons why I kept on saying that I prefer the Nifty 50 as compared to the Bank Nifty. And also note how this index has closed below its 25-day exponential moving average for the first time after 21st December 2020. Now, if it was to remain below this threshold, expect more weakness. Now, let's take a look at the weekly chart next. Last week, I pointed out a long-legged doji, which is marked with a red arrow. And I said that a fall below the low of this weekly candle would open the doors for further declines, which actually worked out fairly well. Now, only if the bulls were to keep the index above the weekly high of 32,842, this index will encounter overhead supply from sellers who are stuck at higher levels. Now, conversely, staying below the weekly low of 31,120 will trigger further selling due to mark-to-market positions and demands by brokers for extra margins. Now, friends, don't forget to keep your eyes on the bond markets, especially if you're trading the Bank Nifty. You can't close your eyes to the bond markets and expect to trade the Bank Nifty. Both are extremely correlated, and it's only the naive trader who ignores the bond markets at the expense of trading profits. Now, I regularly post this data on my social media pages, so do connect with me. I hope we can connect and have conversations going. Now, the week before last, the Bank Nifty was at number 5 on the most volatile list, but this position was maintained on the highest volatility counters, not because the Bank Nifty has lost its volatility, but because due to the sharp decline in the markets, individual stocks have basically seen a high degree of beta escalating on those counters. Last week, I advocated a range between 33,625 on the upside and 30,875 on the downside, which held perfectly well. In the coming week, I expect an estimated, remember I'm using the word estimated here, range between 32,575 on the upside and 29,750 on the downside. Also note that statistical beta or volatility, price volatility, if it rises further, and I think it might, has a very good chance it might, then the range can be violated, especially on the downside. The risk to the downside is higher. Therefore, I repeat what I keep mentioning in my social media posts, especially on days when beta spikes up, that you must trade light and stay sharp and be very, very careful in case of your long positions. You must expect any kind of surprise and unexpectedly large price move at any given point in time. Friends, the Bank Nifty done. We will now proceed to the most liquid counter on the NSE, the Nifty 50. In terms of impact costs and spreads, this is the best counter to trade. Let's now proceed to seeing where the Nifty is headed next week. Friends, the Nifty managed to outperform the Bank Nifty on a week-on-week basis because it fell only 0.43%. And therefore it gave relative protection to the bulls compared to the bank Nifty bulls, of course. But the weakness is definitely undeniable, and this index fell on 3 out of 5 trading sessions, and the bearish candles were larger than the bullish green ones. Note how the price made a higher high, but the RSI made a lower top, which is again called negative divergence. This index is still above its 25-day exponential moving average, which is why I said it is relatively stronger than the bank Nifty. This is a very simple hack, but hey, it gives results all the time. And I believe in keeping my analysis simple for everyone to understand and follow. Therefore, the moving averages form a very big component of our trading setups. I assure you there are more video tutorials coming your way about how to use these as a trading tool. Just bear with me and we'll be releasing those videos on any Wednesday, anytime now. So, the blue dashed trend line coinciding with the exponential moving average roughly at 14,000 levels will provide a rough and ready support at this round number. Now remember, markets are attracted to round numbers, therefore the 14,000 mark might be such a strong support in the absolute near term. Any decline below the 14,000 mark might be psychologically demoralizing to the bulls, and it might just result in a lot more turbulence and a lot more beta than you're already witnessing. My God, I find the statistical beta or intraday volatility mind-numbing. So any thoughts of higher beta is actually a little daunting, I would say, if nothing even more serious. And note how the dashed trend lines are converging, which also marked a short-term stop loss on the Nifty. And trend lines converging at a future date are a very powerful system by themselves, which warn of extremely high volatility in either direction, up and down. This is something that I've covered in my tutorial dated 20th of January, which you can please check out. It's based on Connie Brown's work, which is taught in CMT's syllabus in chapter 4. Now let's go to the weekly chart, which is on your screen, which had logged a bullish inverted hammer in the week before last. Now a hammer, an inverted hammer, cannot be good news. It's formed when the prices open at one level. The bulls attempt to take the markets higher, but the bears manage to hammer the price lower, and the closing is in the lower end of the weekly range. So last week itself there was an inverted hammer, but in the week before last there was an inverted hammer, but it was a bullish inverted hammer, which means the close was above the open. But last week, not only is there a larger inverted hammer, but the hammer itself is bearish red, which means the close is lower than the open of the week. That means that the bears have returned with force, and which means that pressure is likely to remain, and only a sustained trade above the 14,753 mark, which is the high of this inverted bearish hammer, can revive sentiments effectively. Conversely, a fall below the 14,222, which is the weekly low of this inverted bearish hammer, can open up the downsides and invite more selling. In the week before last, this index was at number 9 of the most volatile list, but it has fallen to number 14 for two reasons. Number one, in relative comparison, this index has been less volatile as compared to the Bank Nifty. And the other reason being that the steep decline has seen individual stock counters gaining volatility sharply, and therefore it appears that the Nifty has unduly fallen on the volatility charts. It's not, it's just that stocks have become a lot more volatile. Now, last week I advocated a potential range between 14,825 on the upside and 14,000 on the downside, which held beautifully. The coming week is likely to see an estimated, I repeat the word estimated, between 14,800 and 13,950. Now, a word of caution with beta or volatility being what it is, and it is rising on top of that, don't be surprised if the downsides are exceeded in case of sharp falls. Remember, the week ahead is shorter due to 26th Jan, our Republic Day holiday, and also we have monthly and weekly expiry on the coming Thursday. Now, last week, I mentioned the Jensen's measure, which is something that top shot hedge fund managers deploy in their risk-reward metrics before they enter into any trade. I said the Jensen's measure was extremely hostile towards the bulls, and therefore no fresh positions on the long side were advocated last week. Where is the Jensen's measure now? Guess what? It's even more hostile. So if you want to go long, if you're compelled to go long, please, I remind you, please go ahead with very, very small exposure. Do not expose your flanks to excessive volatility and risk with your capital. Now, this Jensen's measure, I hope, has convinced the skeptics towards the effectivity of statistical models that highly effective fund managers use. And we have our in-house Barracuda, which we rely on heavily to select trades for us. Friends, the Nifty 50 done, I now proceed towards the most anticipated, most popular segment of this video, wherein I give you top 5 counters for high beta traders and top 5 counters for low beta traders. Let's see what they have in store for us. Now, as you can see, this list basically shows the high beta, high impetus counters, wherein you will take very small exposure but wait for larger price moves. The high beta, high impetus list is led by Apollo Tyres at number 1, number 2 Biocon, number 3 Reliance, number 4 Bajaj Auto, number 5 L&T Finance. And the low beta counters, wherein you will take higher exposure and wait for small price moves, is led by McDowell's, Ashok Leyland, Mahindra and Mahindra, Bharat Forge, and bringing up the rear at number 5 is Wipro. Do remember that this hierarchy can change as and when the market beta either slows down or escalates. So friends, I have an update for you. We are updating our YouTube channel every day with a graphic file which tells you the market internals and also gives you an estimated range for the coming week on Nifty and Bank Nifty futures. Do take some time and effort out. It's a 2-minute read, not more, of this file every day late evening. Coming up on your screen, my friends, are my contact coordinates on the social media. I wish you would connect with me. We can have conversations going. You can read post-market work that I post out there for the benefit of traders on what to expect in the markets. And we can chat up about markets and help each other become better traders. I hope you like this video. In the comment section, do let me know what you think of this video. In case you liked what you saw, please subscribe to my YouTube channel. Share my videos with your family and friends and help me spread the word across of a 360-degree worldview of knowledge-based investments and trades. I wish you a very, very profitable week ahead. Vijay Bhambwani, thank you for watching me. Take care of your trades. All the best. Bye-bye.